Here we are looking into a calendar spread of the earnings of Macys and Zoom by just this week, and I will show you how to trade a calendar spread successfully even if the stock is going down and is actually against you. So watch out and have fun. Start with the earnings of Macys, which came out on the 16th of November. So what I did is on the 15th, just the day before, I did this kind of calendar spread of selling a call, buying a call. Now the most important thing is that you are selling a call on the short-term maturity and you're buying one, like I show here, December on the long run. Why? It's because when you look here, the volatility on the short-term side is really high. This is always when earnings come out, you can be sure that the volatility is really high. Why? It's because people have some expectation if the stock will go up and down. So always when you have a situation like that, just sell the short term, or let's say this option which is next expiring, like now 17 November, and buy whatever other option. It can be 1 week later, let's say November 24 or December 1. So I use the same strike and I have to pay this 0.16 for one option, or let's say here 3 pieces times 0.16 or $16. Now already now I know this is my maximum loss. I cannot lose more than what I have invested. Why? It's because I sell and buy actually at the same time, the same strike. So whatever happens to this one, I can cover it by December 1. Now what is my price expectation? I hope that Macy's is definitely opening higher than 13, but now it's very important not too high, because if the stock opens maybe at 14 or 14 and a half, well then both options are deeply in the money. And then actually the profit, or let's say the difference between a November or December, will be just slightly different, but not a lot. In other words, you have both options deeply in the money. So looking now at the Macy's the next day, they had excellent earnings. So the stock really from, let's say, this up around 13 really went up to 14.2 to 14.4, and actually then at that moment my profit was maybe equal to what I bought, let's say 0.15, 0.16. But fortunately during the session the stock actually is easing from 14.2 to 13.5, 13.4, so a bit higher than, let's say, my strike price. Now what happens if the strike price is a bit higher is that you get now actually the real value of the November 17. That means, let's say, if it's 13.5 and it's 13, so the price would be maybe 0.5, just the normal value. But because I have 1 or 2 weeks more in December, I'm gonna have an extra value of a time value, which is maybe 0.7 or 0.8 from 13. So the result is a difference of 0.31. So when I sell now this, let's say, these two options at the same time, I get a credit of 0.31, and here at 0.28, as you see, I have done it in 2 different times. So actually what I bought 0.16, I could sell at 0.31 or 0.28. So it was a nice profit. Here we have a similar scenario of Zoom technology, which the earnings came on the 20th after hours. So in other words, that I actually sold 2 calls 69 and buy 2 calls 69. As you see again, that the expiration is again short term on the selling side, buying term 1 week later. Now here the stock was around 65 or 66 when the earnings came out. Actually the stock held quite good, but then at the opening it dropped to 63, 66, and even on the lowest is 61.83. Now I have paid 0.28, as you can see here, by selling the November and buying the December. Even at that level, you can see when, let's say, supposing you take 62, which is $7 far from the strike price, I still have a value on my December 1, which is almost about 0.15 or whatever. What I cannot remember exactly what happened. But then actually Zoom was recovering, and you can see the close was even 65.94. So almost we closed unchanged. So what happened is that so my 69 call of the short term maybe went up slightly, but the other one, the 69, which the expiry is the 1st of December, had a much higher upturn because obviously there's again a time value. So I could sell both options as a combination with 0.4 or 0.41, as you can see here. So I had a nice profit by again just waiting and seeing that if the stock recovers, I can really make a profit out of it. So I was quite surprised about that. It's because the expectations of Zoom were quite good, but the stock has dropped. But by just having a bit of recovery or by just unchanged, I get a nice profit. Now, why this is the situation is because the volatility on the November 24 was very high. And then actually once the market opened the next day, the volatility crashed on the November 24. There was a volatility of maybe 100%, so it crashed down to maybe 40%. So, but that one on December 1 maybe had a higher volatility too, but just crashed maybe by 10% or whatever. So in other words, I just profit out of it, of the volatility crunch on the option. Coming to the summary of a calendar spread on earnings. Calendar spreads are limited risk strategies. So in other words, you know what you invest. You cannot lose more than what you pay for. And I think this is very good that whenever you go into these earning trades, is a directional risk. In other words, you know what you may lose. And you have seen in my two examples, I didn't do a big investment. It was more a testing. Calendar spreads are mainly used to profit from the high implied volatility at the short expiry. So this is exactly what happens is always that the volatility has a crunch once the stock comes out with the prices. Now you can imagine if you buy a call or a put on earnings and you pay quite a high premium because of high volatility, and you take an example of Zoom technology, which actually open unchanged, so all call buyers or put buyers, they all get squeezed in a way they lost the whole investment. Why? It's because once Zoom came out with the earnings, the volatility crushed on both sides, call and put side. Now, in our case, we profit by the crush because we sold the short term and bought actually the long term option. So even the stock opens low after the earnings, like Zoom, we may profit of the calendar strategy as long as the stock recovers before the expiration of the option which has been bought. So obviously, Zoom technology at the moment went down, maybe 4 or 5%, but it recovers. And as long as the option would recover, the stock would recover before the option expires, we always have a chance to make a profit out of it. Calendar spreads ranges from 1 week expiry to 1 month expiry, selling short expiry and buying long expiry. So in other words, you can make different strategies. You're gonna sell always the short term. I mean, selling is this option which is the recent expiry. But if you buy, you don't have to buy right away. That you have to buy, let's say, at the same time. But the expiration, you are flexible in having an expiration in 2 weeks, or 3 weeks, or even in 1 month. The rule is more or less the longer is the difference between the expiration, or the more expensive it would be. So I tend mostly to between 1 or 2 weeks. So I sell the recent one, that one who expires in a few days, and I buy that one which maybe has an expiration of 1 or 2 weeks. Always use the strategy with out-of-the-money calls or puts, thus profiting from the extrinsic value of the option. So you see in the case of Zoom was trading at 65 and I sold and bought calls 69. In Macys it was the same. Macy was maybe 12.5 and then I sold and bought 13 strike. So you could do the same on the downside. I mean, you could buy a put, say you could sell a put and buy a put, but again out of the money. So this is my recommendation. Whenever you choose the direction of a stock, choose out of the money options. Well, so far the calendar spread on earnings. I think calendar spreads you can adjust for any other strategy as well. I like very much this because, as I said, it's a defined risk. At the same time, you may profit. Mostly it's done on earnings trade because at earnings trade the volatility is always very high on the short-term option, while on the long-term option you may have less volatility crunch. So try it out and let me know. Any questions or suggestions, just feel free to send me an email. That's all, folks. Have a good day. Bye-bye.